I didn't expect business to be so tough this year. We expanded our space, adding more than 1,000 units, but it's been tough to swallow. It's like these cars here. Take a car that used to sell for over 10,000 yuan. Now I'm selling it for 6,000 yuan just to get it off my hands after 6 months. And still, nobody's asking about it. There's a saying, greed is like a snake swallowing an elephant. When your business gets bigger, it's not necessarily better. Having too many cars isn't good either. Look at how packed it is here, jam-packed. That's why this year's business is really tough. Guys, how are we going to sell all these cars? This is our cherry warehouse. Take a look, there are visibly over 200 units, right? We've got Arizo 8, as well as Tigo 7, Tigo 8, and Tigo 6, all right here. These are all from March and April. The market is really tough, you know. We've experienced it deeply. The inventory is already piled up. Take a look over here. This is all from Chang'an's inventory. It's all the same situation.
It's so hard to sell new cars now. We offer 30% off, 40% off, and 50% off, but they just can't be sold. Now these cars have become inventory. As market demand weakens and consumer purchasing power declines, despite efforts by car dealers to reduce inventory through price cuts and promotions, the number of unsold vehicles in China continues to rise sharply. According to the latest China Vehicle Inventory Alert Index survey released by the China Automobile Dealers Association on March 31st, the Inventory Alert Index for Chinese dealers in March 2024 was 58.3%. The index remains above the critical 50% threshold. A higher index reflects lower market demand, increased inventory pressure, and greater operational risks, placing the auto market in a downturn. The China Association of Automobile Manufacturers, CAAM, recently released wholesale sales volumes. Surprisingly, even Li Motors, known for its efficient inventory management, has experienced a significant inventory buildup. Data shows that Li Motors produced 100,000 vehicles in the first quarter of this year, but only sold 80,000, leaving 20,000 vehicles unsold in warehouses. The previously popular L9 has become the inventory king, accumulating 7,500 vehicles over the past 3 months. Additionally, the Li Motors Mega, which launched on March 1st, faced sales setbacks due to negative publicity, resulting in over 2,000 units of inventory. Li Yanwei from the expert committee of the China Automobile Dealers Association pointed out that Li Motors added 20,000 units of inventory in the first quarter, with a total value of approximately 6.2 billion yuan. To reduce inventory, Li Motors has implemented measures such as production cuts and increased retail market incentives. Li Motors announced price reductions on April 22nd, with discounts ranging from 18,000 to 20,000 yuan for the latest L9, L8, and L7 models. The price of the electric model Mega has been reduced from 559,800 yuan to 529,800 yuan, a decrease of 30,000 yuan. The newly launched L6 model, originally priced at 259,800 yuan, has been reduced by 10,000 yuan. This marks Li Motors' first official price adjustment for newly launched models. At the end of last year, Li Motors achieved a maximum price reduction of 30,000 yuan through local subsidies and terminal discounts. Earlier this year, after the redesign of the L series models, the 2023 models of L Motors saw price reductions of up to 33,000 yuan. Alongside the price reductions, Li Motors will provide cash rebates to owners who have already purchased the 2024 models of Li Motors L7, L8, L9, and Mega. Following this announcement, Li Motors Hong Kong stocks plummeted by 9% on April 22nd, ultimately closing with a decline of 8.14%. Since March 1st, Li Motors Hong Kong stocks have cumulatively fallen by 45%. Li Motors' official price adjustment signifies the extension of the price war to the segment above 300,000 yuan, further intensifying industry competition. Insider sources reveal that Li Motors' decision to reduce prices was made based on feedback from frontline sales. The company clearly senses increased competition this year compared to last year. Although foot traffic in stores remains steady, customers now take longer to make purchasing decisions, with stronger tendencies to wait and see. Against this backdrop, Li Motors has decided to stimulate market demand by reducing prices. Another mainland media article suggests that Li Motors' price reduction is a result of intense competition in China's new energy vehicle market. Looking at sales figures, in the first quarter of 2024, Li Motors delivered a total of 80,000 new vehicles, a year-on-year increase of 52.9%, compared to a growth rate of 65.8% in the first quarter of 2023. From weekly sales figures in April, Li Motors' weekly sales are currently around 7,000 vehicles, with an expected monthly sales volume of around 30,000 vehicles, significantly lower than the company's previous target of 50,000 vehicles per month. The article suggests that lower-than-expected sales have resulted in significant inventory for Li Motors. Sang Zhiwei, an expert from the China Automobile Dealers Association, pointed out on April 11th that in the first quarter, Li Motors' L9 had the highest inventory. L7 and L8 models were affected by market factors as well, with an inventory of over 10,000 units, and Mega's first delivery month was affected by marketing events, resulting in an additional inventory of 2,000 units. In this context, inventory clearance has become Li Motors' most important task, requiring the company to reduce production plans and increase incentives in the retail market to achieve supply-demand balance. Just a day before Li Motors' price reduction announcement, on April 21st, Tesla had announced price cuts for its domestically produced Model 3 and Model Y, with reductions ranging from 14,000 yuan. The starting price for the rear-wheel drive version of Model 3 was lowered to 231,900 yuan, and for the Model Y to 249,900 yuan. To increase sales, it's been reported that since April, over 38 automotive companies with a total of 126 models have implemented price reductions or promotional adjustments, including 84 traditional fuel models and 42 new energy models. This marks the first time in automotive market history for such a large-scale price reduction. However, the China Passenger Car Market Information Joint Conference believes that the new round of price wars will once again cause consumers to adopt a wait-and-see attitude, which won't move inventory. An analysis by Voice of America on March 20th suggested that China's automotive industry elimination game is just beginning, with an estimated 70% of brands expected to leave the market within 2 years. Some analyses suggest that the reason behind Chinese auto companies slashing prices reflects the reality of declining sales and market saturation in the Chinese automotive industry. Zhou Lijun, chief analyst at the Yiche Research Institute, told Caixin that price wars reflect market sentiment, and the larger the price reduction range, the worse the market conditions. Excess capacity release, juxtaposed with insufficient demand, has become the primary contradiction in the current mainland automotive market. Data from the China Passenger Car Market Joint Information Conference shows that as of the end of February 2024, there were 3.21 million passenger cars in inventory on the mainland, with manufacturer inventory accounting for 660,000 units, or 20.4%, and channel inventory accounting for nearly 2.55 million units, or close to 80%. On April 10th, the China Association of Automobile Manufacturers, CAAM, released the automotive production and sales data for the first quarter of this year. According to CAAM's data, in the first quarter of this year, China's automobile production and wholesale sales, including exports, reached 6.7 million and 6.7 million units respectively, representing a year-on-year growth rates of 6.4% and 10.6%. However, CAAM stated that the new growth in automobile production and sales in the first quarter was based on a low base in the same period of 2023. Moreover, exports grew by 33.2% year-on-year, exceeding one-fourth of the total annual automobile exports in 2023, which was the key factor driving the high growth in automobile production and sales this year. However, domestic market sales in China only increased by 6.2% year-on-year, and CAAM believes that the issue of insufficient domestic demand in the current automobile market remains prominent and needs to be addressed in 2024. The National Development and Reform Commission's Price Monitoring Center released monitoring data on April 22nd, showing a widespread decline in prices of new energy vehicles in Shenzhen since the beginning of this year, with general declines ranging from 5% to 10%. Among them, 10 monitored new energy vehicles experienced price reductions, with the largest decrease seen in the BYD Song Plus DMI 110 CAAM flagship model, whose price dropped from 154,800 yuan at the beginning of the year to 139,800 yuan, a decrease of 9.7%. The monitoring center stated that the price decrease is mainly due to oversupply in the market, reduced battery costs, and advantages in scale in the entire industry chain. According to the Shenzhen Price Certification and Monitoring Center, from the supply side, China's production of new energy vehicles reached 9.4 million units in 2023, with a year-on-year increase of 30%. Industry data shows that only BYD, Huawei's Wenjie, and Li Motors plans to deliver an additional 2.3 million units in 2024, while market demand forecasts only anticipate an increase of 2.1 million units. The market is expected to remain in a state of oversupply in the long term. Battery costs account for about 50% of the total vehicle cost. Data indicates that the price of domestically produced lithium carbonate in China began to decline rapidly after reaching its peak at the end of 2022. Compared to the peak price of nearly 600,000 yuan per ton, it has now dropped to around 100,000 yuan per ton, a decrease of 80%. Industry insiders report that for every 100,000 yuan per ton decrease in lithium carbonate, the manufacturing cost for a pure electric vehicle with a capacity of 70 kilowatt-hours can be reduced by over 10,000 yuan. The center predicts that competition in new energy vehicle market in 2024 will be exceptionally fierce. Price wars may take various forms, including price reductions and positioning adjustments. In the context of huge production capacity that China's domestic market cannot absorb, exports have become another track for new energy vehicles. Energy policy expert Mo Zhengchun stated that China is actively expanding into the electric vehicle markets of Africa and Southeast Asia, including Thailand, Indonesia, Malaysia, and Vietnam, all of which have shown promising performance. However, concerns in Europe and the United States about being controlled by a highly dependent Chinese green supply chain have led to joint resistance efforts. Both U.S. Treasury Secretary Janet Yellen and German Chancellor Olaf Scholz visits to China have brought up the issue of China's overcapacity. Yellen emphasized her particular concern about China's long-standing macroeconomic imbalances, weak household consumption, and excessive corporate investment, exacerbated by the Chinese authorities' massive support for specific industry sectors, which pose significant risks to workers and businesses in the U.S. and other countries worldwide. Professor Qiu Wenjun from the Department of Finance at Boston Northeastern University, in an interview with Epoch Times, stated that overcapacity is a problem that the Chinese Communist government must face. There are three main reasons for overcapacity. The first is China's national subsidy policy. China tends towards a planned economic system, so once government authorities identify industries with potential, they typically provide various forms of subsidies. Industries like solar panels, lower-tier semiconductor production, and steel have been controversial focal points. Second, it is closely related to China's lack of innovation and entrepreneurial spirit. Because any innovation or startup company involves significant risks, the entire economic environment in China discourages startups. Everyone rushes to follow trends, leading to competition, not in quality, but in price. Third, from a market perspective, although the market for electric vehicles has been increasing over the past decade, the infrastructure of electric vehicles, such as charging stations, has not kept pace. In situations where mileage is limited, consumers may have reservations about purchasing. Under a free market economy, manufacturers are generally sensitive to market demand. Under a subsidy economy, they may not be as sensitive to market prospects and may not make adjustments accordingly. In fact, the Chinese Communist Party has previously acknowledged overcapacity. The annual Central Economic Work Conference held in December last year proposed excess capacity in some industries. Scholars observe that the deviation between quantity and price has become an important issue facing the Chinese economy, and its root cause is the price decline caused by overcapacity, where companies increase revenue without increasing profits. According to data from the General Administration of Customs, in just the first quarter of 2023, the export of electric vehicles, lithium batteries, and solar cells increased by 66.9% year-on-year, with an incremental increase exceeding 100 billion yuan, boosting the overall export growth rate by 2 percentage points. The export of electric passenger cars reached 64.75 billion yuan, a 122% increase. U.S. Treasury Secretary Yellen stated that unlimited output will no longer be tolerated. The U.S. initiated an investigation into China-made connected vehicles at the end of February, and on March 5th, U.S. senators proposed a bill to impose a 125% tariff on Chinese cars. To cope with the boycott, many Chinese car companies have moved to Mexico or Europe to establish factories in order to enjoy local free trade benefits. Due to oversupply in the Chinese automotive market, zombie factories continue to increase. Previously, the Financial Times in the UK reported that as consumers choose electric vehicles and sales of gas vehicles stagnate, more and more factories in China that originally produced gas vehicles have experienced a sharp decline in capacity utilization rates, some of which have begun to idle or be mothballed, becoming so-called zombie factories. Taking Hyundai as an example, the company invested $1.15 billion in a new factory in 2017 with an annual production of 300,000 fuel vehicles. However, 6 years later, as Chinese consumers rapidly shifted to electric vehicles, gas vehicle sales stagnated, forcing Hyundai to sell the factory in December last year for less than a quarter of the initial investment. Li Hangku, director of the Chungbuk Automotive Convergence Technology Research Institute in South Korea, said, "The factory has been losing money continuously, and the Chinese automotive market is facing a problem of oversupply. No one is willing to buy the factory at a high price." Analysts predict that hundreds of zombie factories will emerge in the Chinese automotive market over the next decade. Data from the Shanghai consulting firm Automobility shows that China produced 17.7 million fuel vehicles last year, a 37% drop from the peak in 2017. Bill Russo, founder of Automobility, stated that the cliff-like decline in fuel vehicle sales means that up to half of the industry's capacity, about 25 million vehicles, is not being utilized. Additionally, according to mainland media reports on March 12th, in Nanning, Guangxi, the Hozan Auto Nanning factory, which is considered a major landmark project by the local government, has been shut down for over half a month. Previously, another electric vehicle company, Hi-Fi, announced a 6-month shutdown of production on February 18th. Regarding the issue of overcapacity in the Chinese car manufacturers, Sun Guoqiang, associate professor at Nanhua University in Taiwan, stated in an interview with the Epoch Times that Chinese EV manufacturers benefit from the Chinese government's new energy credit policy and explicit government subsidies, which are the true focus of China's overcapacity in new energy. Sun Guoqiang pointed out that it's necessary to pay attention to China's party-state system, which leads the entire government in guiding the development of industries, unlike free markets in democratic countries. Sun Guoqiang said that mainland China faces a series of problems, such as real estate, debt, and unemployment. The so-called New Growth model focuses on both internal and external circulation. Internal circulation claims to construct its own supply chain, while external circulation aims to export through competitive industries. The entire external circulation relies on the so-called New Three: electric vehicles, lithium batteries, and solar panels. Therefore, we can expect that despite international questioning, the CCP will continue to forge ahead and squeeze other countries out of the market. Sun Guoqiang believes that when Western countries deal with challenges like the Belt and Road Initiative or excess capacity in renewable energy, they should thoroughly assess their industries and collaborate across sectors to address China's competitive position effectively.